The Chinese real estate market is in peril. The largest private developer in China has missed payments on its foreign obligations. The majority of developers are having trouble renegotiating their domestic bonds. Over the previous 11 months, home prices have decreased. The new building has been reduced by 45%. The developers that collected significant funds by pre-selling units that had not yet been constructed are to blame for most of the tension. However, the households that obtained mortgages to purchase these dwellings have threatened to stop making payments because some failed to set up reserves to ensure the completion of these units. Although China's real estate crisis poses hazards to the economy, it is ultimately an issue with economic expansion. It is simple to understand how a short-term recession in the real estate industry could grow into a protracted financial crisis, given that the development and building of new property are responsible for over a quarter of the nation's current economic activity. China has relaxed while most nations have tightened. Following consecutive data releases that indicated further economic weakening, China's central bank unexpectedly lowered interest rates by 10 basis points, 0.1%. The nation's economy is deteriorating due to policy choices that the Chinese Communist Party, CCP, insists on upholding after decades of rapid expansion. China's regulatory assault on technology and education enterprises was one of the country's current policies, as measured to limit leverage in the real estate market. Many observers believe that the nation of China will save the globe again as the world's major economies have sluggish development because of excessive prices, exacerbated by the crisis in Ukraine. This is in contrast to 2008 when countries in the West surpassed the financial situation in the speed of recovery because China's economy was then growing quickly, and a powerful stimulus program introduced by the government of Beijing. Nevertheless, the economic issues China is currently facing are serious. Premier Li Keqiang raised an alarm that there is now little interest in expanding existing policy. As a result, the government's 5.5% GDP growth objective for this year has all been abandoned. The zero-COVID policy of Beijing, which resulted in employee lockdowns in many enterprises for several months, has halted business and consumer growth. Exposure to China as an investment may be risky, given the country's present economic climate. Trade relations, regulatory activity, and government policies all have an impact in addition to the economy. However, it is also essential to watch out for any indications that China's position on the actions brought to this situation may be changing. Unsurprisingly, economists are suddenly downgrading their national GDP growth projections. China's inflation rate is 4.2%, which is significantly lower than that of the United States and Europe. However, things may change if lockdowns are loosened and consumer spending picks up. There are indications that investors, businesses, and skilled employees are losing faith in China, in addition to the immediate economic statistics. Fresh out of college, students and expatriates are relocating to other nations, while multinational corporations like Apple, Nasdaq, AAPL have started transferring operations to Southeast Asia. If the pattern persists, this might have longer-term effects. In actuality, China has not handled the virus like the remaining part of the globe. As a result, if COVID-19 suddenly swept the nation, economic pandemonium would arise, according to Jacob Gunter, who is the senior analyst at the Berlin-based Mercator Institute for China Studies, MERIX. There is a lot of vaccine hesitancy, says the author. They don't have a very advanced healthcare system and built-up protection. They also declined to bring in the mRNA vaccinations. The government's recent stricter debt enforcement of real estate innovators stimulated a real estate crisis that put China Evergrande, one of China's biggest home builders, in danger of going bankrupt. Bank financing for real estate acquisitions has plummeted. For the first time in a decade, home buyers in China are no longer paying their mortgages for unfinished flats and the amount of residential floor space, an indication of new building activity reduced by nearly 50% in the second quarter. The property downturn is the larger crisis than the zero-COVID policy, according to Pantheon Macroeconomics China expert Craig Botham. Lockdowns have proved that the economy can rapidly be redeemed, but the effect from an industry worth 30% of GDP's declining asset prices is substantial. After less than expected growth in retail sales and industrial production, as well as a 10% year-over-year decline in oil demand, China's central bank reduced interest rates. The bank will not provide monetary support until the pandemic and inflation are under control. How did China's real estate crisis start? It should be mentioned that persuading homebuyers to finalize contracts for homes that have not yet been built is a typical real estate sales strategy in China. Before COVID lockdowns interfered with supply chains and work processes, and forced some real estate developers to delay projects. This did not appear to cause any serious issues. However, a few developers unintentionally had to declare bankruptcy because of higher costs. China lowers while rates soar globally. This is happening, according to Gunter, who spoke to DW, in contrast to the world at large, where nations are increasing their rates. The speaker added that Chinese consumers are hesitant to spend out of fear that they will be restrained without pay, saying that China faces the opposite challenges to those we face in the Western nations. According to Botham, the most recent rate reductions are unlikely to affect the economy significantly. They will only have a direct effect on bank funding costs. They won't affect the real economy at all. Also, and most importantly, is the sharp decline in loan demand. So the PBOK, People's Bank of China, was compelled to respond, knowing that its actions will have little effect. Botham added, by pressing regional governments to take greater action, the central government has tried to draw focus away from Beijing to help stabilize growth and improve job opportunities. But this was viewed as being untrue because the prospect of additional stimulus is on hold. Botham cautioned that local governments cannot do much more since their balance books have lapsed. We require action from the federal government. China's leaders are already under increasing pressure as a result of the appeal for change and growth. Financial News quoted Wen Bin, the chief economist at China Minsheng Bank, saying that Beijing should increase its stimulus spending to intensify demand. The study also urged expanded industrial agreement and real estate market reforms, arguing that doing so would spur a resurgence in both output and consumption. All inflation is not bad. Since moderate inflation encourages expenditure, central banks usually aim for an annual inflation rate of 1% to 3%. Inflation tends to increase when it rises above that level and becomes difficult to control. Additionally, excessive inflation lowers the actual value of savings and people's purchasing power. Companies consequently have less capital to reinvest, which ultimately slows economic growth. The understanding: investing in times of market volatility. Long-term outcomes are typically better when a portfolio is well-balanced and built to profit from or survive various events instead of being made primarily on a single prediction. Investing veterans have mastered the art of thinking in possibilities rather than in absolutes. As an investor, you lower the volatility and risk of your portfolio if you have exposure to various industries. In addition, you can modify your portfolio if your investment thesis on any stock changes due to macroeconomic circumstances. The role China's government plays in the current mortgage crisis. Chinese officials have implemented further measures in addition to the nation's zero-COVID policy, which has resulted in widespread lockdowns in China. By taking out bank loans, they also decided to restrict developer leverage. The speculative bubble in the real estate market was slowed down by doing this. But the current shift in the economic landscape has left the developers struggling with liquidity. Regulators have mandated that banks extend additional loans to these businesses to prevent the sector from imploding. The risks would undoubtedly be transferred to the banking sector as a result. Insight: some experts believe China's mortgage issue is just getting started. How will the government control inflation? When inflation rises too high, central banks utilize monetary policy tools, such as interest rates and money supply, to reduce it. Recall that higher interest rates make borrowing money more expensive and saving more desirable, which reduces the purchasing power available to businesses and consumers. In addition, because there is less public economic demand for goods and services, companies cannot raise prices. The learning: central banks may need to take a chance at a recession to battle inflation. Although they harm the economy, recessions often don't continue for very long. On the other side, inflation has the potential to go out of control and eventually wreak more significant economic damage than a temporary downturn. According to analysts, a Chinese mortgage crisis similar to the subprime crisis that led to the global financial catastrophe in 2008 is just starting. According to statistics, mortgage loans represent most of China's banks' $9.2 trillion real estate market risk. The top 100 developers in China missed close to one-third of their loan payments last year. For years, there have been worries about China's banking and real estate industries. But there are finally some obvious indicators of problems. When investing in China's banking or real estate industries, investors should exercise extreme caution. China might try to manage a permanent downshift in real estate investment by implementing steps to preserve and enhance household demand and developing creative ways to help the industrial sectors rely on excessive property investment retool to meet domestic consumer demand. First, however, Chinese government leaders must most urgently face the brutal truth that China's record growth surge is probably a thing of the past due to mounting internal debt and the end of an extremely high investment period.